It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of Misinformation. Take charge of your financial future with your personal bank. Now here's Ference Toth.
Welcome to Your Personal Bank Show, and I'll tell you what, I try to keep things pretty upbeat and positive and stay, educational focused most of the time. But I'm going to tell you what, every once in a while, and I've mentioned this before, but every once in a while there's an article or a blog or a message that comes out and just, to be frank with you, it just gets my dander up. Yeah, it's because it's so misleading, so full of bad information that it just gets frustrating. You know, with what we do with Your Personal Bank concept, I understand this, that what we're doing is it's not commonly known with the general public. Now, by the way, this tool is used quite commonly in banks and corporate finance boards, executives, wealthy families, family offices, those kinds of things. In those arenas, the personal bank concept and what we're doing is frankly quite common. With the general public, the average, what the industry calls the retail investor, and I hate to say this, but the reality is most of us, normal Americans, the folks listening to this show, in the financial industry, they're considered retail investors. There's the institutional side too, and most people are aware that exists, but frankly don't have a lot of understanding about what it does or what's the differences or how it works and that type of thing. And so, just like you've probably, if you've been listening to the show, you heard the promos and all that. Yes, I'm a financial advisor, or I've been in the financial industry, I should say, 22 years. I own an agency. I've been one of the top producers, top 10 in the country with both in annuities and life insurance arenas for many of those years. But most importantly, I've been an entrepreneur for I hate to say how long, but it's over 25 years. We'll put it that way. It's amazing. It's approaching 30 years, but I've owned a retail business. I've owned a service company. I've owned a contracting business. I, of course, own the agency, the financial agency for the last 16 years, by the way. And then most recently, a couple of years ago, we started the process of starting a FDIC insured bank. And I'm the chairman of the board of the bank. And I'm going to tell you, folks, that whole process has been quite the learning experience for me. Even myself, someone who's been in the financial industry 22 years. I've been an entrepreneur, all that. I've learned a lot about the banking industry and the institutional side of investing and things like that, more than I even knew before. And I had been aware of the personal bank concept for some years prior to that, and been using it, recommended it to clients because I was fortunate to come across it about 7 years ago, actually. And like I said, my story kind of illustrates why the number one question I get from folks all the time, and I did talk about this quite in depth last week's show. Why is my advisor? Why didn't I hear about this before? Because once people look at this, they're like, and really look into it, they're amazed and they're surprised in most cases and very favorable in turn of what I'm saying. Like, wow, this is better than I thought, or this works better than I thought, or the numbers are better than I thought. I had no idea. Those are the kind of why. And then naturally, the next question: why haven't been told, or why didn't my advisor, whoever, tell me about this sooner? And again, it's not. It's a lack of familiarity. It's probably the best way to put it. And that's probably the number one reason I decided and agreed to do the show, because I've shared this so often that literally, I'm not kidding. I've been speaking to different investor groups for the last 5 or 6 years around the country, at least prior to COVID, online sense, of course. And even still today, if I have 50 or 100 investors on an online training call or back when I was speaking in person, and I say, usually one of the first things I'll bring up is how many people here are familiar with the insurance banking concept or have looked at it or, have some familiarity with it. And I'll get 2 or 3% of the people that will respond that they have looked at this before, and a handful have actually even done it. But it's a very small percentage, and it still is today. And it's better than it was. I'll grant you that. And I'm excited about that because the message is getting out there that this is a financial tool that can be used just like any other financial tool, It's no big mystery about it. It's just it's something that the average person has not been introduced to. And it works very well for a lot of different purposes. And again, last week's show, I talked about many of the different purposes. If you missed those, I encourage you to go to yourpersonalbank.com, and you can tune in and listen to any of the previously recorded shows, and get that information. So by all means, do so. But like I was starting to say, there's sometimes information goes out, and there's a lot of misinformation or lack of information with articles and advisors because of the very fact of the lack of experience, the lack of knowledge, the lack of familiarity with this financial tool. Okay, perfect example. Literally, a couple days ago, I was dealing with a Money Radio listener who reached out to me, who had actually set up one of these high cash value policies some years ago with the idea of growing the cash, like we talk about. Now, by the way, remember, what's Your Personal Bank concept? In a nutshell, it's really simple. You set up a high cash value policy that could be a fixed or an indexed policy. The idea is it's designed to grow cash. It's not designed to maximize death benefit. It's designed to grow cash. So the amount of cash growth in it is significantly more than what any traditional policy would be out there and what most people are familiar with. And like I said, we have fixed options, companies that have been paying 6% plus dividends every year for the last 25 years plus, never miss a dividend since before the Civil War. So again, these are high dividend paying companies, A+ rated, billions of dollars in cash reserves. These are companies all right? And I can show you which ones, who's paying the best dividends, and I'll show you their track record of the last 25-year history, for example. Then the second step, and this is, again, where we separate ourselves, we've taken it to another level. So those folks who have been introduced to this concept, and like I said, that's slowly growing, which is great. Actually, it's starting to grow faster than it's good. But the point is, if you have been introduced to this or you have done this, like this gentleman had done, it behooves you, I would highly recommend you contact me at yourpersonalbank.com and let us do a comparison. Because the way these things are structured, and again, we've taken it to the next level with the bank line of credit. See, there are banks, and this is a specialty area of lending, and I only knew about this because of, some of the banking stuff and things like that, contacts and connections that I've obtained over the last few years. And there are banks that will offer a line of credit based on the cash value of the policy. Now, from an understanding standpoint, an analogy is it works much on the same principle as a HELOC or a home equity line of credit. Most people are familiar with a HELOC and how they work. Basically, if you have a property and you have equity in the property, often a bank will offer a line of credit against the equity of the property or the value of the property. Okay, and then basically those by the way, those bank lines of credit typically have no points or fees, no costs, and they'll even it's an account. They'll give you a checkbook if you want. In many cases, and really you can write a check or pay bills or expenses or whatever based on what you only get charged interest on the portion you use. And typically the interest rates are very low because it's a collateralized loan. Remember, the equity for that loan is the equity in the property. Well, again, that's a very good analogy because these bank lines of credit against the cash value of the policy works in a very similar method. Now, there's one difference that's even more positive, but the key is the equity or the collateral for the loan is the cash in the policy. And these banks will loan up to 95% of the cash value of your policy. So so the interest rates are very low. Like I said, they're in the threes, between 3 and 3.95 right now. And historically, I've always been very low because it's a very low risk loan. So when I come back in the next segment, I'm going to talk more about some of the common misconceptions about this, and we're going to refer a little bit to this article because, unfortunately, this misinformation and misconceptions, I find, happens far too often, and it's better to know the truth. So stay tuned in the next segment.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
All right, welcome back. We're leading up to here some of the common misconceptions with the Your Personal Bank concept. misconceptions, misunderstandings, misinformation, if you will. Like I said, my dander's kind of gotten. I try to be pretty upbeat in most cases, but gosh, every once in a while you just see an article or a message that just kind of gets you riled up, and I've got one of those, and I want to clarify some things, clarify some misunderstandings and misinformation, and it's unfortunately common because the main reason that I think is, like I said in the first segment, this is a very specialized area of in the financial world. This is a tool, your personal bank concept, again, where you're setting up a high cash value policy to maximize cash value. Those can be based on a fixed index rate, a fixed or an index. The index, of course, is the S&P 500 typically, where you can get up to, you have a downside floor of 1% up to 14% annual growth. Okay, that's today. So you can still get a nice return on your monies without the downside risk. And the average the last 25-year history return on that is 8.5%, by the way. I think most people, looking back on their portfolio, if they had 8.5% average rate of return over the last 25 years, tax-free, by the way, so don't forget that portion, I think most people would be pretty satisfied. In fact, I think most people, I'd venture to say, be pretty darn happy about that kind of return over an extended period of time. And remember, if it's tax-free, what's your income tax bracket? 8.5% taxable, tax-free compared to a taxable, you're probably looking at, depending on your bracket, somewhere in the range of a 10% return after tax, okay? So that's significant, folks. And like I said, you have no downside market risk. In fact, that option is pretty popular with a lot of people because the other part people don't realize about it, they say, well, my upside's limited to 14%. If I'm just in the markets, say, another typical investment, the upside's unlimited. Granted, but so is the downside in most cases. Here, you've got the floor. In other words, each year that you lock in a gain, it's now locked in. It never goes backwards from that point. An often used phrase, which I like, is how should I say? It's compared to like the stair-step approach to investing is the term. And it really works like a stair-steps. Stair-step, if you think about it, each year that it does go up, you lock in that gain, and then you never go backwards. You never go down. If the next year's flat or goes down, you stay flat. The downside's protected, and then you go up from there. And when you consider that, again, can't predict what the future is going to hold, but based on the last 25-year history, 8.5% is not bad. You put in the tax-free aspect, so that increases your overall return even further, and you're protecting your downside so that each year you lock in a gain, it doesn't go backwards. Well, that gets pretty darn interesting. And then when you add on top of that, we bring in the bank line of credit now. And remember, the bank lines of credit, depending on the company or the amounts we're talking about and such, are somewhere between 3 and 3.95%. Well, if you are averaging 8.5% and you access the money and you borrow it in the threes from the bank line, you keep the difference, don't you? And the difference could be 4 or 5% difference, right? Annually. So in other words, these are on dollars you spent. Let's say you're using those dollars to supplement retirement, for example, or any other purpose, really. It doesn't matter. But you spend those dollars and you actually continue to gain positive arbitrage as a result. I mean, it's really strong. And then, of course, the fixed option, as I've said oftentimes, we've got companies paid 6% dividends the last 25 years plus every year without skipping a beat and have paid dividends since before the Civil War. Folks, are you kidding me? That is one heck of a long track record, okay? And they didn't miss through the Great Depression either. And they've got billions of dollars of reserves. They have the capability of continuing to pay those dividends out long-term, A-plus rated, all this good stuff. In fact, I heard one of the CFOs a year or so ago at one of the meetings I was at, that question came up, and he stated that based on their financials, and this is not uncommon with many of the better-rated insurance companies with higher cash reserves, he said we could pay out the current dividend rate for the next 100 years even if we had no new customers. Folks, that's the kind of dividends or cash reserves we're talking about, the long-term focus on long-term dividends. So if you're looking for income, consistency, dividends, and you don't consider this tool, the personal bank concept, my opinion is you're doing yourself a disservice. And that, again, is probably the number one reason why most advisors and most people are not that familiar with it. Again, the institutional world is very familiar with it. Banks, corporate finance boards, executives, wealthy families, family offices, outfits like that use this tool very commonly. It's well known in those areas. When I'm dealing in that world, I told you I'm chairman of the board of a bank in formation. I'm dealing with people like that on a regular basis and have been for the last few years. That's like, oh yeah, they're absolutely completely aware of it. I want to let you know in on a little kind of a secret, a bit of a secret. A lot of those folks then, when I'm talking to them from a business standpoint, from our bank, and maybe talking to them about potentially working together as partners, bank partners with our bank, we're in the process of starting and all this. And then I kind of ask them, hey, by the way, I tell them what I do for a living, and they're like, oh, that makes a lot of sense. And then they usually will tell me that they already have many of these types of personal bank policies personally. Some of them, and I can't say who they are, have become clients, others who've already done it for years, but some of them, I find it ironic, they're in the financial world and they're recommending other things, more common things that most people are aware of, like, the whole, we hear it all the time. Yet I look at their personal financial situation and much of their money is in the personal bank. They're setting up these because it's tax-free. They can create tax-free income, guarantees, consistency, or they do the index or a combination of both. And I find it ironic, and, they make me promise not to say their names. I've got a couple of names that some people will be aware of who they are, who are clients of mine. And the thing is, and I ask sometimes, I don't want to be too difficult to deal with, if you know what I'm trying to say. My job is my role as I'm the advisor is to, do the best for that my client, right? But I'll say, by the way, you've been in the like great example, you've been in the IRA or 401k world, your business is that, you're the one of the top execs with this company, you've been doing this for a decade or two. How much do you talk to your clients, customers, or folks about this? And in most cases, the answer is little or none. And I'll often ask why. And I say, well, frankly, they're not experts in it, okay, which is valid, which is another topic I'm going to get onto because, this is something, again, it's a specialized area of the financial world. If you're going to talk to somebody who's not that familiar with it, and that would be the vast majority of advisors, that would be akin to going to your MD and saying, hey, you got heart problems, and he's recommending heart surgery. What's the first thing the medical doctor, the primary care physician is going to do? Well, they're going to refer you to the heart surgeon, aren't they? Because that's the specialist. And I do work as a specialist, as I've mentioned a few times, for a handful of financial advisors who readily admit they're not insurance experts, and certainly not experts with the bank line of credits and the banking world either. And that's what the personal bank concept is about. Again, a very specialized area of the financial world, though, it can make a world of difference for your financial future. So we'll discuss this further in the next segment. I haven't gotten to my article I want to get to, so I promise the next segment, stay tuned, we'll start talking about that.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
All right, we're back, and if you were listening to the first couple segments, I promised I was going to get to this article. It kind of got my dander up, and it's like I've often said, I try to be pretty positive. I understand there's a lot of misunderstanding and miscommunication about the personal bank concept and how it works because, well, frankly, most people are not experienced or knowledgeable or experts in it, and I'm including most advisors, CPAs, or anybody else for that matter. I know this from personal practical experience. I train CPAs, I train advisors, I work with clients, I speak on to investor groups. Just, there's very few people out there that specialize in this. And again, it's a good analogy is, how many heart surgeons are there compared to medical doctors, family care physicians? Obviously, it's a very much more specialized area of medicine. The same thing here. So this article, and I'm not going to dignify the article, the name, or who it is, because one, I don't want to get in and argue with them and start problems. But the reality is, I don't want to give it any more airtime because this is so bad So egregious, it just got my dander up, okay? And like I said, the first thing they say, and this is supposedly somebody who's a financial advisor and insurance agent, and they're supposedly on a life insurance focused blog they're doing. And the first thing they say, and I think they just say this to grab attention, but they say that here's a secret most life insurance companies don't want you to know. You shouldn't buy whole life insurance. Now, like I said, why are we telling you this? Sounds strange thing for a life insurance company to say, but we're more concerned about getting our clients good information about making money. Well, first of all, what they just said there absolutely makes no logical sense. I think it's just an attention grabber. Because if a life insurance company who their primary focus, their primary business happens to be whole life insurance, why would they tell you not to buy their product? Okay, that they wouldn't be in business. So, that's like a pizza restaurant saying, hey, yeah, we're in the pizza business, but we don't want you buying our pizza or coming in to eat at our restaurant. Come on. There's no logical sense here. This is just an attention grabber. And by the way, I've worked with many companies who specialize primarily in whole life insurance over the last 22 years. I can tell you none of them that I've ever dealt with I've never heard of anybody say that. I've never heard any executives say that. I've never heard anyone ever say you shouldn't buy our product that we're putting out there. In fact, they're proud of their products they're putting out there, and they believe in them. Otherwise, they wouldn't even stay in business, would they? So this is just pure attention grabbing, okay? Now, then he puts on, here's the truth. Whole life is almost certainly not for you. I can almost guarantee it. Well, he just says it's for a selective group of people, and they fall high net worth individuals he's talking about, and then folks who want a more conservative investment are the two. Well, there's quite a few high net worth individuals out there. He may not deal with many of them, but I can tell you in the banking world I do. Okay, that's for sure. And in my financial, in the financial world, deal with them a fair amount. Okay, so that's kind of all right, whatever. And then the other part is people who want to be more conservative. Well, there are many, many studies out there that have shown that somewhere upwards of 80% of Americans tend to lean towards a more conservative side when it comes to their finances. I understand. I'm listening to Money Radio, and I've got a lot of folks here who have been involved with the markets for decades even and have been very successful with that. And I say kudos to you. That's awesome. That's great. But I can tell you that's not the majority of the American public, okay? And I think you know that because, many of you, when you talk to people about investing that have a lot of experience with it, you may know some friends, of course, who do, but you also know friends and family members who don't so much. You know what I'm saying? And the thing is, for those of you that are in the markets and are happy with that and have a lot of success with that and all that, the personal banks concept is still for you because what we can do is we can enhance your returns with the positive arbitrage aspect. I mean, think about it just a minute. If you flow money into a policy and then you turn around and access it from the bank line of credit to go invest in any assets into your portfolio, and you can pick up a 2 or 3% positive arbitrage in that process, the question comes back to, well, why wouldn't you do that? Or why would you not look at that? Because if your average rate of return is, let's say, 7% or 8% or 10%, I don't care. You tell me what your returns have been. My response is simple. Well, how would you like to add 2 or 3% to that? You do realize that even if your average rate of return over, say, the last decade or two was 10%, you did really well. Okay, I think most people would agree that's a good rate of return. You have done exceptionally well over an extended period of time. I'm not talking about 1 or 2 years. I'm talking about over, a couple decades or so. Well, here's the reality. If you add 2% to that return, you just added 20% to your overall rate of return, didn't you? 20% increase in profits. Take a business. You add 20% profit to the top line profit of any business or family or household for that matter. That can make a huge difference in your amount of money you've earned or made or your return. How much more money is in your pocket? How much more are you going to have to spend in retirement, right? So I'm not saying those of you that are in the markets and are happy with what's going on should change what you're doing. In fact, I'm saying don't change if it works. Keep doing what you're doing. What I am saying, though, is add one piece to it. Add the personal bank tool to your arsenal. You're missing a bullet in your belt is what's going on if you're not using this tool, frankly, in most cases. Because when you consider the ability to pick up the positive arbitrage, increase your returns by a pretty, some people say, I had somebody say to me the other day, well, what's a couple of percent? What's the big deal? And then they were talking to me about how they were investing in other stuff and they were making 5% returns. That's what they told me. Well, I said, I'm not talking about you making 2% versus 5. I'm talking about you making 7% versus 5, 7 or 8. They're like, oh. I said, yeah, that's huge. Well, yeah, that's like almost 50% increase on their returns. Okay? These were real estate investors, by the way, happen to be fairly sizable. And so I showed them how flowing them through the policy, then accessing through the bank line of credit, they picked up another 2-3%. And they were making 5 on their current investments. So now they're making 7 or 8. It's about 7.5 in their case. That's a 50% increase, folks. That's huge. Now add that over the next decade or 2 or 3. Now, and throw compound interest into that whole factor, and you're talking about a huge amount of additional monies and returns, okay? So when this person who clearly doesn't understand the personal bank concept, obviously, it's not even brought up, and I hardly ever find an article it is, to be fair. Now that opens up a whole new world of people. And we didn't even talk about the folks who lean towards more the conservative side or want, I've talked about this many times. Even modern portfolio theory tells us, 60-40 stock bond split is a kind of good rule of thumb, right? We've all heard that. And if you're nearing retirement, you probably should be more 50-50. And if you're younger, maybe 70-30 or 80-20 even, maybe. We've all heard that. It's been around since the 50s, folks. And, most people agree that it's worked out pretty well. Now, here's the thing. The modern portfolio theory talks about stocks and bonds, but the reality is when you read into it a little further, really the bond portion of the portfolio is really not about bonds. It's about consistent income. It's about a portion or a bucket of your money that's more consistent, gets more steady returns. Folks, if you're getting a 6% dividend tax-free and the downside's guaranteed, and they've been paying that for 25 years plus and plan to continue to do so, doesn't that kind of fit that criteria for the more conservative bucket or portion of your portfolio? Oh, by the way, you also gain tax-free tax benefits. Can anybody benefit from paying less taxes? I think the answer would be almost universal. That isn't talked about in this article at all either. So, like I said, I'm going to talk to you a little bit more about the next segment. But what I want you to understand is this personal bank concept is a valuable tool and is a usable tool to enhance the financial situation for nearly everybody I talk to, frankly. So stay tuned in the next section, and we'll talk about that more.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
All right, welcome back. And like I said, we're rounded third, and I've been talking about some of the misconceptions and clearing up some things in terms of the personal bank concept. And what kind of got me on that topic was I read this article that got my dander up. It got me frustrated because it was so full of miscommunication that I just had to bring it up. And like I said, I'm not going to dignify the name of the article. I don't want to give it any more attention than it unfortunately already has gotten. But like I said, they talk about why. First thing it says, insurance companies don't want you to know. A secret is they don't want you to buy whole life insurance. If you're an insurance company, your primary product is whole life insurance, why in the world would you ever say that? I mean, you wouldn't be in business, would you? So that absolutely makes no sense, and it's an attention grabber, okay? The thing is, companies who do this believe in their products, understand their products, they understand the value of the tool, and on all the uses for it. I mean, here's the thing. One of the comments I get quite often when I work with a new client is I start sharing with them, hey, we got companies paying 6% dividends the last 25 years plus. Never missed a dividend since before the Great Depression. And I get surprised. Wow, I had no idea there were any companies that had done that. Yeah, they've been doing it. These are name companies you and I know, A+ rated, billions of dollars of cash reserves. They're set to pay these dividend rates out for extended periods of time. Okay, they paid these dividends through the Great Depression. Okay, these are companies set up to do this. Even a medium-sized insurance company does $1 billion of new business a year. Some of the big boys do billions. So we're not talking about, any penny ante stuff here. And the comment I'll get is, wow, I had no idea this was so big. There was so much. Yeah, there's a huge industry. Billions and billions of dollars go into this every year. And then when you add the bank line of credit, now that's even more, that's a specialized area of lending for the banking industry. But I'm dealing with a couple of banks, and one of them's got over a couple $1 billion of these loans on the books. They've been doing this for the last 25 years. So this isn't, again, penny ante stuff. They're not poking it with a stick, trying to see if it'll work or not. No, these are companies who have been doing this for decades, hundreds of millions to billions of dollars of loans on the books. And remember, they're doing the bank line of credit. They're using the cash and the policy as the collateral for the line, and the interest on the line is less than what you're earning. Right now, the rates are you can earn 6 and get charged in the 3s. Well, if you are you're getting credited 6 on your policy, and you access it and you pick up an extra 2 or 3%, positive arbitrage, you keep the difference, right? What can you do with that money? Could you invest it? Sure, of course you could. Could you increase your rate of return on your investments? Absolutely. Do you want to make an extra 2 or 3%? I mean, if you had think about this a minute. You sat down with one financial advisor and they said, okay, based on your portfolio and your situation, blah, 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 we can put, many of you have been through this. We put together a plan and we expect we're going to get a 7% rate of return on your money. Okay. You sit down with the next one, looks at everything, and they say, well, we can anticipate a 9 to 10% rate of return on your money using the same investments. Oh, and by the way, add some tax benefits in there, so some of that money will be tax-free. And you were fairly convinced that both options were viable and would happen. Which one are you choosing? You see, by adding the personal bank concept onto the portfolio, whatever it is you're doing, you're only going to enhance your returns, because if you pick up positive arbitrage, you can do nothing but enhance what you're doing. It's that simple, okay? Now, if you need the money to pay bills or expenses or debt and all that, of course, you can do that too, all right, and still get positive arbitrage so you can reduce your cost of borrowing. That's the other way I've looked at it. I've talked to many folks about it. You're looking to buy a new car, and you've chosen on the car, and you decide you're going to finance it. And the interest rate on the one car is 5%, the loan, and the interest rate on the other one's 3%. Same car. Same amount of money total. One has a 5% rate, one has a 3%. Which loan are you going to take? I mean, these are no-brainer decisions, right? That's what the personal bank does, adding to it enhances. So you're going to get, if you choose the fixed option, you're going to get the positive arbitrage, okay? So you're going to increase your rate of return, whatever that rate of return is. And that's why this article is, again, it doesn't mention anything about the personal bank concept. Obviously, most don't. So when they're saying that, this isn't for most people, the answer is, do most people want to increase their rate of return if they're investing? I would say the answer is yes. Do most people want to reduce their tax liability? Personal bank concept, we can grow tax-free income, all that kind of good stuff. I would venture to say the answer is yes. Okay? So when you and then don't forget, there's long-term care, living benefits, things like if you get critical, chronic, terminal illness, these are built in. If you don't have long-term care, or you're paying for long-term care and you're tired of paying for it, you want some protection, in my opinion, I've said this over and over again, you have this benefit. It's there if you need it. If you don't, you didn't pay for it. So what could be better than that? So do most people want to have some type of long-term care, serious medical protection, money's available for that kind of thing, just in case? I'd say the answer is yes. And then I know this is the part that most people, when they think of life insurance, think of first. I think of last, because in most cases, when I'm dealing with a client, we're focused on maximizing cash, maximizing returns, reducing costs of borrowing, minimizing taxes. Those are all our primary focuses. Yes, there's some medical long-term care benefits available. That's nice to know it's there. But the last one, though, I said, oh, by the way, you don't want to forget this part, and COVID's kind of brought this to light a bit more. Most people don't like to think about it, but the reality is, have you protected your loved ones in case something happens to you? Now, a lot of people say, well, I've got enough money, da-da-da. What I find is, in most cases, a lot of that money has significant tax consequence when it goes to the next generation. IRAs, 401ks, qualified accounts, we all know, are defined as tax-hostile accounts. I mean, you can see anywhere from a third on upwards of those type of accounts when they pass to the next generation being wiped out by tax. Okay? That's where life insurance can come in and mitigate that and reduce that tax liability, total out-of-pocket significantly. It's one of the biggest things tax attorneys do, by the way, one of the most common tools they use. But the other one I find probably most common that I see used for, yes, for legacy planning and pass on to the next generation, there's no better tool, no more efficient tool to mitigate tax than using a life insurance tool. There just isn't. Okay, and you ask any credible tax attorney, and they'll tell you the same thing. But the other thing is, the one I find most common is, if I've got a couple, and let's say the couple is nearing or in retirement, and most cases, both are receiving some sort of Social Security or pension benefits. And if one passes prematurely, then, of course, there's going to be a reduction in Social Security income. Well, having a death benefit in place, even though that maybe wasn't our primary focus or purpose, but having one there just in case something does happen, that can offset an awful lot of lost Social Security or pension income that would have been lost in many cases if one of the parties passed away prematurely. So when you put all this together, you put in the ability to grow your money, enhance your returns if you're an investor. I don't care what type of investor you are, but add an extra 2 or 3% returns to your investments, which for most people that can translate to anywhere from a 10, 50 to 20 to 30% increase on their money. I've even seen 50% increase on returns. You can reduce your taxes, your tax liability in the long run. You have protection for major medical or long-term care situations. You have money for that. And you have some protection for loved ones in case something happens prematurely. When you put all that together, when this article says this isn't for most people, he just doesn't know what he's talking about. The reality is this is for most people. So contact us at yourpersonalbank.com. I'd love to talk to you about how it affects your situation, enhance your financial future, and we'll talk to you next week.
Listen Tuesday at noon and Thursdays at 1 for more information on Your Personal Bank. Contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may charge. Contact yourpersonalbank.com for current rates.